Good morning and welcome to MarketCast 7. Yep, it's the Halloween special. You might have guessed it from the crazy shirt. We did stick a couple of shirts out there on LinkedIn and this one was the clear favourite. I have to say, for me as a very old man, to wear a shirt that's actually not tucked in, well, it's close to sacrilege. But I'm assured by those people that know better, the fashion gurus in my purview, that it would spoil the effect of the shirt if I was to tuck it in. Here we are at the AF Oliver offices down here in Bournemouth, and as you can probably see behind me, they're all decked out for Halloween. It is October the 31st, and we have got half an hour to do so much. So the idea of this is, the idea of this next half an hour is to try and give you a sense of all the crazy upheaval that's gone on in politics and finance and geopolitical issues that actually have a significant bearing on the UK residential market. We're going to review what's gone on briefly. We're going to touch on it. I'm sure you had all seen it on the news bulletins. We are going to make some guesses. There is no way in the world that we can actually look forward to how the market's going to run over the next 6 to 12 months without making some assumptions. So we're going to do a little bit of guessing. We're going to explore what that actually means to us, what those various scenarios of how the market might move will feed their way through into frontline selling prices, and then we'll examine those possibilities and the effect that they might have. In the end, I'll draw some conclusions and I'll tell you where I think it's all going. But let's start here with a picture of our Prime Minister. Sorry, this was a deck I presented a few days ago. Sorry. Let's start here with our Prime Minister. Oh no, sorry, that was a couple of days later. Let's start here. Oh, there we go. Let's start here with our Prime Minister. Yep, we've got Rishi now. Not that Joe Biden can pronounce it quite that way. Go figure, eh? But Rishi, during the hustings, I've been going back trying to pick out some of the key things that he said that would actually affect us in the UK resi market during the hustings. He's going to densify the inner cities. That's a big target of his. He wants to stop the developers land hogging. I can almost hear a few of you spitting out your coffee and slamming the cups down. He's a big fan of methods of modern construction. That's something that he is going to support and push forward. And he seeks to protect the green belt. Not a huge amount new in there, but of course with the arrival of Rishi, we saw a little bit of a comeback too, didn't we? This guy's back, Michael Gove is back. He comes back with his reputation as the man that gets things done. He's a passionate believer in the 300,000 units a year target for new homes. Best of luck with that, with the current supply issues and planning crisis. And he is also what I've termed, my term, as the Building Safety Fund bully. Yes, he is the man that introduced the scary threats to actually ensure that the builders were making a significant contribution to that building safety fund. We'll avoid politics and avoid touching on that, but that's the political backdrop that we're looking at. We had our mini budget, didn't we? We had the classic mini budget. The last time I presented to you, it had just happened. It had just happened, and the fallout wasn't really starting to become evident. Of that mini budget that we talked about last time round, the bits that stayed in following the appointment of Jeremy Hunt were the stamp duty changes. That's a big deal for us in the industry. And the only reason they stayed in was because it was too late to stop them. They'd already gone through. National insurance reductions as well stayed in. Obviously, Michael Gove has stayed in or come in. The bits that actually got thrown out with that budget, the tax cuts, I'm sure you're all aware. The 2-year energy freeze, the energy cap has been shrunk down to 6 months. The corporation tax reductions, the halt on corporation tax going up has also been thrown out. And I stuck down in the corner here a maybe, because the investment zone plan, and a number of regions all around the UK were already applying for investment zone status. We don't quite know how they are going to fare and how that's going to end up. So that's another one of those guesses, another one of those assumptions that we're actually going to have to make. Okay, so let's just have a quick look at the current gloomy outlook. Excuse me, hopping from a slide to slide there. I put this story up here. This came out of Property Industry Eye. It's good daily bulletin website for the resi industry. And you can see in here, it's got banks are preparing for house prices to fall by a third. Now, my inference when I first saw that headline was, oh my goodness, they're actually predicting, the banks are predicting that prices are going to crash by a third. Well, no, of course they're not. And actually, when you read this in here, what they're saying is they are starting to stress test buyers and stress test the market to see that it could cope with a fall of up to a third. But it's classic headlines like that that actually get picked up by the mainstream press, don't they? And you know, we've seen it all before. The Lloyd's Group, they actually came in. This was just on Friday, I think. This hit the press and started to be published. And their mid-range forecast was that prices may fall by 8% next year. They also give what they call a severe scenario that sees them falling 18%. And in fact, if you actually read that Lloyd's Group release, they go from a fall of minus 2.7%, that's their best bet, all the way down to 18%. And hey, there you go, pick anyone out of there. That's another major organisation, institution that realises it's a lot of guesswork in looking forward and predicting how this market's going to move, because there are so many variable parts. And if you look into underneath here, we've got a whole bunch of banks who are forecasting the market to move backwards anywhere, and I've found them anywhere between 0 and 25%. It's an extraordinary range of possible movements, and certainly for the developers in this audience, it makes forecasting through the next 12 to 24 months insanely difficult, and we'll take a little look at that. I also thought this was worth a shout because, of course, I hope you see what I did here, by the way. Help to buy. That's not a typo. That's a little bit of creative copywriting. I ought to go into the advertising business. Today, of course, is the last day. It's 31st of October, and that is the last day for Help to Buy applications. And of course, these things then property needs to be ready by the end of the calendar year, 31st December, and they have to complete by the 31st of March. The reason I think that is significantly important is Help to Buy has been such an important part of the market since it was introduced in April 2013, and now that's going, the need to find a replacement is really important, and it doesn't look like that's coming from government anytime soon. And it means that for every developer out there, the need to have a creative and an innovative IFA working with you is absolutely vital, and I'm sure we'll see some really creative schemes coming up over the next few months. I'm sure there's numbers of you out there planning that already. But despite all that and all those gloomy headlines and all those predictions between 2 and 25%, I do not see a crash. I still don't see a crash. I worked all the way through the 1990 market, and I worked all the way through the 2008 market, and there are so many differences between those markets and the one that we face now. I think probably the most significant being the change in qualification stress testing for people wanting to take out a mortgage from 2014. So after the 2008-9 downturn, the banks, the institutions, the government made it tougher for the banks from 2013, and the banks made it tougher for borrowers from 2014 on. So that really is a huge difference between where we were in 1990 and 2008 and where we are now. Equally, supply is still restricted. It's still a little bit of a race. We'll come back to that. employment market is still red hot. There are more vacancies than there are people out of work. The hiatus that we actually have in the employment market and so on means that the market is still red hot. That's very important for us. The changes in stamp duty are going to go ahead, and we know this is going to make a difference. If you've watched these MarketCasts before, you've seen me put that chart on that shows you where the spikes go when the stamp duty changes. It's one of the most hated taxes in the UK, and we know that home buyers change their plans to account for stamp duty changes and to avoid that tax if they can. The pound, the lower pound will encourage foreign buyers, certainly into the bigger cities, the London market in particular. And as I said just a moment ago, the stress testing, the lenders and borrowers have both been stress tested much more strongly. And in terms of borrowers, all the way up to 7%. I don't think we're going to see a crash. I'm going to put my name to that, and I'll come on to where I think the market's going to go over the next 6 to 12 months in a moment or two. Anything's possible. Here, how about this? I don't know, did you see this story? This was in the Times on Saturday. It's true, honestly, I've not fudged this. Mortgage rates falling at their fastest since the mini budget. I thought I'd somehow pulled up a newspaper headline from 6 years ago, and I had to double check it. But no, this was this Saturday. And what they're actually saying is that now the political situation is stabilised. Well, stabilised, quite honestly, from where we came, anything would be stable, really, wouldn't it? But we've now got a sensible chancellor in there who is going to take the national debt and funding for any giveaways very, very seriously indeed. The gilts prices have dropped, the interest rates have dropped that the government's paying, so of course this is feeding through into the markets. And now we can see here that the 2-year fixed rate average in this story, it's saying that the basket of 2-year fixed rate mortgages has come down by almost 50 basis points, down to 6.48. And as you can see here, there are a number, or if you read the story, you'll see rather, there are a number of other institutions who are waiting to see what happens on Thursday at the MPC meeting to see what they're going to do next. Don't forget that the industry and the markets have almost certainly priced in a 75 basis points, 0.75% in old money already, which would take base rates to 3%. That's probably already in there. I'd be very surprised if the MPC went any lower than that, although I do hear there are a couple of dove voices in there that are trying to talk that down. But I think the market's priced that in, and I don't think we're going to see any shocks in interest rates or mortgage rates after that announcement. So these are all good reasons why I actually can't see this crash coming, and that the fact that there is now a little bit of downward pressure on interest rates is actually quite incredible. So we've had our blip and our crazy moment, and now we've got some reasons to be optimistic. This slightly more stable government, whether the Home Secretary is going to be there by the time this MarketCast goes out. I was listening to the news on the way in, and it was still Suella Braverman on the way into the office a few minutes ago. So if it's not now, please don't blame me for that. But we've also got a levelling off, a stabilisation of fuel costs and energy costs, and I know there's now more tension in the conflict in Ukraine, and that might feed back into more inflation. But you get a sense that we've had the shock and we are now stabilising. I'm no economist, as Stuart Paisley of the HBF tells me on a regular basis, and I fully accept that. But if you actually look at all of these basic factors that add in to how the market moves, I get a sense that it's stabilising. There are causes for concern. Of course, there's going to be a rate increase on Thursday. We all know that. The 17th of November is going to be a big date for all of us. That's the autumn statement. So that's the really considered track forward from the Chancellor on the 17th. The Chancellor and the Prime Minister doubtless has had a lot of input into that. And so that's going to affect things dramatically. It was going to be today, of course, but they wanted to wait to see this webcast first, I understand, somebody told me. And of course, we've also still got this geopolitical uncertainty in the Ukraine that's going on. That's massive. This is really interesting. You'll remember I spent quite a lot of time on this last month, not quite so much time today, but the GfK Consumer Confidence Barometer. This data here, by the way, was collected between the 3rd and the 13th of September. So before the resignation and so before the massive fallout from the mini budget. And look at this. So if you remember last month, we had these record lows, didn't we? Remember that the red line here is the overall index about how people think things are going to be over the next 12 months. Anything below this red line through here means they think things are getting worse. Anything above it means that things are getting better. And the red line had plunged all the way down here to a record low in the 50 years that this survey's been running. And it's had a little bounce back. You'll see that the overall index has had a little bounce back, and I think it's possibly reached just about as far down as it can go. And unless the Russians actually start coming up the beach at Dover, I think that's probably just about as far down as it can go. And you can see down in here, this blue line here is how these 2,000 respondents that GfK ask, that survey on a monthly basis, that's had a little, from a record low down here. How's the economy going to go over the next 12 months? It also has had a little bit of an uptick from a record low. And even in terms of these respondents' own personal finances, that's had a little uptick too. Now, generally, what tends to happen with this survey is they find a sample that is a little more positive. All of the factors in the survey tend to go the same way. So it really was of great interest to me to see that this green line, which is how people feel about making a major purchase over the next 12 months, actually fell a little bit, which is a little bit of concern to me. So this is people saying, I think I'm going to keep my money in my pocket for a while, and I'm actually going to see how things develop, how things turn out. So no great surprise there, I hear you shout. This is interesting. This matrix is what I base my sense of how things are going to go in the near and mid-term future. These are the factors that I believe directly affect the UK property market. And you can see in here, on the positive side of this matrix here, in the green, this is stuff that we actually can't do anything about directly. Low supply, high demand has a very positive effect, and it's very high impact. It's right up here, just driving this market. We all know that. And you can see low fixed rate mortgages. This is, by the way, pre-mini budget. And then in here, this is stuff that the developers can do as that market starts to transition, because we've known, haven't we, for 3 months that we'd reached the top of the market. I've been telling you that for 3 months. We all knew that. And so this is stuff that the developers can do to actually add into this positive effect. And you can see lifestyle changes were driving it too. And then down in here, we had mortgage rates were starting to come up, weren't they, just prior to the mini budget? Do you remember? Homeowner running costs going up, after with the conflict in Ukraine and so on, low affordability, consumer confidence low, etc. And there was this really scary one, the mortgage availability. Then there was the mini budget. And so we actually went from there to there. Look where mortgage availability went from down here to up here. It was massive. In the week after the mini budget, the institutions withdrew 1,700 mortgages from the market. Gone. Now, it's a really simple thing, If you can't get a mortgage, you can't buy a house. End of. So, and that's about 2/3 mortgages of every house purchase in the UK. So that's a massive driver for the market. And you can see it moved right up here to high impact, maximum negative effect. And in here, of course, following close behind it, we had mortgage rates rising exponentially almost, low affordability moving up as well. The one bright spot in here that changed was the stamp duty changes. Can you see it up in here, post the mini budget? I looked at this again over the weekend, and this is where I've actually got this now. So this mortgage availability has slipped back here. The institutions are putting mortgages back in, and I think that is going to continue to ease as we see stability come back in government, and that feeds through into gilt costs and government borrowing costs, and that feeds through into the overall market. And you can see here that this low supply, high demand is rebalancing. It's moving back that way. And so here's our opportunity here to actually introduce the developer-driven benefits. And you can start to see these come through in the market. Now I'm seeing them out there already. Our old friend Part Exchange, obviously, in there too. Finance products and the replacement of Help to Buy is dramatically important too. But the discounts here, you can see prices are being reduced. And that's so important because I hate to tell you this, but as this market transitions and moves out, the developers are going to take the biggest hit on this in the first instance. I'll explain why I say that in a moment or two. This is the matrix that's driving my thinking right now on where this market's moving. I'm into my last 10 minutes, believe it or not. It's gone so crazily quickly, so I'm going to trot through the charts. Everything I'm showing you here is actually available online, so I don't need to spend too much time, but I just want to show you this data behind this thinking and just give you a flavour of what that data is telling us. An extraordinary little uptick in asking prices according to Rightmove, which I found amazing. But what I counter that with is some data that I've looked at both from Zoopla, who put some great data in on asking prices and achieved prices this month, or last month actually, and also from Property Mark, which I'll show you in a moment or two. Here's the oh, I've jumped to there. Here's the Property Mark. I thought this was a great chart. This is the Property Mark index here of properties that were sold here in the grey at below asking price, here in the red at asking price, and here in the blue at above asking price. This goes from October 2021 up to September last month, 2022. What a fantastic indication that is of how things are changing. If you want a really perfect graphic indication of a market in transition, it is right there for you in blue, orange and grey. I was always going to say in black and white. I think there are just over 200 agents in this survey, this Property Mark survey, but I thought that was really great data. So when Rightmove say, guess what? Asking price has gone up by 0.9 of a percentage point, yeah, and the number of properties being sold at asking price or above is reducing. This is still, by the way, nowhere near where it was pre-COVID, which was over 70% pre-COVID below asking price. So it's still good. So it's getting almost, like I say, getting back to normal, but it's still way above where it was pre-COVID. So these are the classic Rightmove charts. Not going to spend too long on this. Here's asking prices evening out, and we know that properties aren't making asking prices. Here's the 5-year trend, and you can see this evening out too. Average time to sell continuing to climb. All of this gives you the picture of where we're at. This is another very important set of data here. First time buyer affordability, it's going to be a big issue for us with Help to Buy going. This little line down here is the 4.5 times income for a single person. This yellow line at the top there is 4.5 times income on average, obviously, for a dual income household. And look at that, there's your price in the middle there. There's your average price. So the single person on average income is really going to struggle to make that. And you can see here, is it better to rent or buy has gone off the chart here. Here's buy and here's rent. So we've got some work to do there on FTBs. I like to take the Rightmove map and regional trends because these are big regions, so they're not really helping when we're looking at micro markets, but I like to compare them over a 3-month period and see what the rate of inflation is, whether it was better or worse than the period on the previous 3 months. And I compare July and October here, and you can see in every single region in the UK, it's downwards. Nationwide, I was hoping I might have grabbed that this morning. It's due at any minute now. And of course, I've sort of pinned my colours to the mast with regard to where I think that's going to go this month. And it's going to be published like today or tomorrow or something, and probably embarrass me. But back in September, it had just dropped out of the double figures mark down to 9.5%. But this is the chart really that you need to take a note of. It's a 3-month and 3-month chart, and we can see where the trend is going there. You don't need my beautifully crafted red arrows on that chart to show you where the trend is going. You can see it for yourself. The price to earnings ratio, I'm leaping ahead there. The price to earnings ratio is a really important number as interest rates rise, and that has just started to tail off over the top as we enter into our last 5 minutes. Halifax telling pretty much the same story. You can see there they've got annual price change at just under 10% as well. This has been very, very sensitive this morning. It's almost like a government minister, this remote control. You can see here Zoopla at 8.2%. This was the chart I was telling you about just now. These are the buyers who've asked for reductions from asking price. That's where it was here in Q3 2019. And this is where it is now. So these are the number of buyers in a percentage terms that are asking for reductions on asking price. That's really important when you think about the Rightmove numbers. Mortgage approvals took a big uptick to 74,000 in August. I don't have the September numbers yet. They'll be out any moment or two, but it means that we're going to see those volumes, those final sales volumes, moving up to 110, 115,000 as we approach the end of the year. Inflation here, it's old numbers now. This is the end of July. The end of August, or even the end of September, sitting at 8.8%. But we know this stuff, so I'm not going to dwell on it. Mortgage rates, these are really volatile right now, but we know, don't we, that a good rate is going to be anything over or in between 4 and 5%. Anything beginning with a 4, then you'll snap somebody's arm off there to take a 2-year fix. And right now they're over 6, of course, but coming down. I'm only going to show you a couple of slides out of the RICS deck. This one here, here's regional newly agreed sales. This was the September numbers, so this was in August. Here's the level, here's getting worse. You don't need me to add to that. These are new vendor instructions. Here's level, here's getting worse. You don't need me to add to that either. This is how the agents see volumes going over the next 3 and 12 months. You don't need me to add to that either. And here are the regional charts. All of these available on the RICS website. I just wanted to give you a flavour of how the agents are looking, and these are price expectations over the next 3 and 12, and price expectations for the region. Only Northern Ireland stand out on their own as being very, very upbeat and enthusiastic about where prices and volumes are going to go in the next 12 months. Interestingly, I think this is probably the best indicator of agent stock is the Rightmove one. It's the most indicative and with the broadest coverage. And you can see that steady climb up as we predicted right here on MarketCast. It continues to climb like a row of teeth. So where are we headed next then? So 2 or 3 minutes left on, and I deliberately put the crystal ball up there because there is an element of crystal ball in this. I mean, you cannot sit down with a computer. Ask the guys at Lloyd's Banking Group, and they come back with expectations that vary by over 15%. So there is an element of the crystal ball. That was where I left you with the market factor matrix. And that's what I'm basing my thinking on, and I'm making some assumptions until maybe today, tomorrow we'll learn the October numbers there. This is how I guessed October, November and December we're going to play out, and you can see where that takes us there. And on that basis, really importantly, these are average selling prices in here, and where that takes us, come on now, where that takes us is it means that we will see some price falls before we get to the end of the year. But this is where I believe we're going in the next 6 months. So you can see that if we go here in October and we actually drop down to just below 8% in October, We'll find that out shortly. November, you can see just above, and then I'm still sticking with my end of the year, 6% inflation based on last year's prices. And then January, you can see they're coming down to 4, 3, 2, and then April level, and then May we start to drop into minus. But what's really important is actually taking those numbers, because they're all based on the year to that month and the previous year. So in price terms, although from February to March we are falling in the percentage annual rate of inflation, prices will actually uptick as we go into the spring market. And I'm convinced that's the case. But we will end up with an average price somewhere around 263, 264. The actual numbers on here, the raw numbers, are actually less important. It's the trend that matters. And we're currently sitting, as you can see, around 274. So it's a fairly significant drop. And what's really important is that not all properties are equal. Have a look down the Zoopla Cities Index. You go from Nottingham at 11% positive inflation to Aberdeen at 1% negative inflation. So the regions will have make a massive difference to that. Look at the Zoopla numbers. Here we go. This is how flats have increased in value but over the pandemic period, and this is how houses have increased in value. So the property type and its location will have a huge bearing on its rate of inflation, and I talked to you about this last month. Not enough time to do it justice again today, but let me tell you, you can see how this is going to move. This is 2009-10, just after the 08-09 recession. So what happens is when the market is great and the availability is low, then the cost of the level of the new homes premium widens. Those two lines diverge because obviously you can't get houses elsewhere. Then the developers will leverage their values. As that changes and the supply-demand imbalance starts to rebalance its way out, well, then those lines will then converge again. The long run average according to Land Registry is 23%. And at the moment it's running at 40%. Now that's got to close, and that is why I believe that the developers are going to take the brunt of the early movement on prices. So in summary, unless there is some sort of cataclysmic event, which I've not envisaged, the market will not crash. So I'm talking about over the next 6 months, unless something absolutely unforeseen happens, we are not walking into a market crash. The regional variations, I think, will become even more extreme, and that market will move down at very, very different rates, exaggerating the differences. The new home average values, I believe, will fall faster than second hand. And I think that what we'll see in quarter one, we will see a slight correction. So it's quarter one next year, we'll see a slight correction. And then in quarter two, I think we'll see us coming down to around minus 3%. Any further than quarter two next year, well then stick me in with the Lloyds Banking Group and their 270 strong team of economists, and I'll tell you it will be between minus 2.7 and minus 18. I'll weigh in with the boys. So thoughts as how that might affect your quarter four strategy. It's everybody round the table. It's setting out the expectations on market according to what we've got to sell and where we've got to sell it, and drawing up a plan A, B and C. And I think we might be approaching a time where we have to be a little bit brutal and commercial about that. There are classic canary indicators that will actually tell us very, very accurately where short to mid-term trends are headed. And on that way, then we can build a price curve for each development and achieve best possible returns for it, but making sure that we don't actually fall off the pace and end up with roofed unsold. You know, bearing in mind that the current rate of sale has almost halved in the last 7 or 8 months. So lean into your independent financial advisor. That is absolutely crucial. And think back to some good old-fashioned direct marketing techniques. Maybe, hey, send your prospect a letter on paper. How weird would that be when it comes through your letterbox? Okay, we've run over again very slightly, so I do apologise for that huge amount out there to add into the whole conversation, and I'm not firing quite on all four cylinders, having spent the last month recovering from a bit of surgery as well. So you know, do forgive me if we weren't quite firing on all four, but lots to be thinking about, and I'll be back in full fitness and health and leaping about like a young gazelle for MarketCast 8. And I shall see you then. Big thanks to Joan, big thanks to James, the production team this morning. Have a great day.